Every entrepreneur wants success, but what separates those who make it from those who don't? The difference lies in smart decisions, the right strategy, and relentless execution. Today, we're diving into game-changing business insights that can take your career or company to the next level. If you love learning about business growth, make sure to subscribe. We're always bringing you valuable, real-world tips. Like this video if you're ready to level up, and let's hear your thoughts in the comments. What's one piece of business advice that changed your mindset? Imagine this. You're sipping coffee at your favorite cafe, scrolling through your phone, and you come across yet another story of someone who struck it rich seemingly overnight through investing. It's tempting, isn't it? The idea that you could turn a small sum of money into a fortune in a short time frame. But is it really possible? Before we dive in, take a moment to answer a few questions. Do you prefer stability over uncertainty? Are you comfortable with the idea of potentially losing money? Do you have the patience to wait for long-term results? Are you willing to educate yourself continuously about the market? Can you manage your emotions during market fluctuations? Keep your answers in mind as we explore whether it's possible to get rich quick through investing. The allure of quick riches. The notion of getting rich quickly is undeniably alluring. It appeals to our desire for instant gratification and the dream of financial freedom. The media is filled with stories of individuals who have made it big overnight. The tech startup founder who became a billionaire, the stock trader who hit the jackpot, or the cryptocurrency enthusiast who struck gold. These stories are enticing, but they often omit the crucial details of the risks, failures, and years of hard work that preceded the success. Take, for example, the story of Apollo. Apollo invested in a trendy tech startup just before it took off. Within a year, his investment had multiplied tenfold, making him an overnight millionaire. However, what the headlines didn't tell you was that Apollo had been investing for over a decade, suffering through multiple losses and learning from each mistake. His quick success was built on a foundation of patience, persistence, and a willingness to take calculated risks. The reality check: risks and rewards. Investing by its nature involves risk. The higher the potential returns, the greater the risks involved. Let's break down some of the common investment avenues that people consider for getting rich quickly. Stock market. The stock market can offer substantial returns, but it's also highly volatile. Prices can soar or plummet based on market sentiment, economic indicators, or global events. Successful stock investing requires thorough research, a deep understanding of market dynamics, and often a bit of luck. Many investors get caught up in the excitement of a bull market, only to see their investments diminish when the market corrects. Consider the case of Cassia. She invested in a hot biotech company after reading an optimistic news article. The stock price skyrocketed initially, but when the company's new drug failed clinical trials, the stock plummeted. Cassia learned the hard way that stock market success requires more than just good timing. It demands rigorous analysis and an understanding of the underlying business. Cryptocurrency. Cryptocurrencies like Bitcoin have created overnight millionaires, but they've also wiped out fortunes just as quickly. The crypto market is notoriously unpredictable, driven by speculation and regulatory news. While the potential for high returns is real, so is the risk of losing everything. Remember Orion, who invested in Bitcoin in early 2017? By the end of the year, his investment had multiplied several times over. But when the market crashed in 2018, he lost nearly all his gains. Orion's experience highlights the wild swings and high risks associated with cryptocurrencies. Real estate. Real estate can be a lucrative investment, but it typically requires significant upfront capital and knowledge of the market. It's also not a quick way to get rich, as property values appreciate over time and involve additional costs, such as maintenance, taxes, and management fees. Consider the story of Lyra. She bought a rental property in an up-and-coming neighborhood. Over the years, she managed the property diligently, dealt with tenant issues, and reinvested her rental income into property improvements. While it took nearly a decade, her property's value eventually doubled, providing her with substantial returns. Lyra's success in real estate came from patience, effort, and a long-term perspective. Lessons from the greats: slow and steady wins the race. Let's draw some wisdom from renowned investment experts and their philosophies. The Intelligent Investor by Benjamin Graham. Benjamin Graham, known as the father of value investing, emphasized the importance of a disciplined and methodical approach to investing. His philosophy revolves around buying undervalued stocks and holding them for the long term. Graham's approach is about minimizing risk and focusing on steady, consistent growth rather than chasing quick profits. Graham's famous quote, "The individual investor should act consistently as an investor and not as a speculator," underscores the importance of a steady, informed approach to investing. The Warren Buffett Way. Warren Buffett, one of Graham's most famous disciples, has built his fortune on the principles of value investing. Buffett's strategy involves investing in high-quality companies with strong fundamentals and holding on to them for the long haul. He famously said, "The stock market is designed to transfer money from the active to the patient." Buffett's success underscores the importance of patience, research, and a long-term perspective. Buffett's story is particularly inspiring. Starting with a modest sum, he built Berkshire Hathaway into one of the most successful investment firms in the world. His approach is characterized by deep research, a focus on intrinsic value, and a steadfast refusal to follow market trends. The Little Book of Common Sense Investing by John C. Bogle. John Bogle, the founder of Vanguard Group, championed the idea of low-cost index fund investing. Bogle's philosophy is based on the belief that over the long term, it's nearly impossible for individual investors to outperform the market. Instead, he advocates for investing in a diversified portfolio of index funds to achieve steady, reliable returns. This approach reduces risk and eliminates the need for constant market speculation. Bogle's mantra, "Don't look for the needle in the haystack. Just buy the haystack," simplifies investing and makes it accessible for everyone, emphasizing the power of broad market exposure and low fees. The psychological aspect of investing. Investing isn't just about numbers and strategies, it's also about managing your emotions. The fear of missing out, FOMO, can drive irrational decisions, leading to buying at market peaks and selling during downturns. Behavioral finance experts like Daniel Kahneman have highlighted how cognitive biases can impact investment decisions. Understanding and managing these biases is crucial for successful investing. The story of Nia's emotional roller coaster. Nia was an avid investor who prided herself on staying informed. During a particularly volatile market period, she found herself constantly checking her portfolio and making impulsive trades based on the latest news. Her emotional responses led to significant losses. Realizing her mistake, Nia took a step back, reevaluated her strategy, and focused on long-term goals. She started meditating and journaling her thoughts to better manage her emotions during market fluctuations. Over time, her disciplined approach paid off. Personal stories: The Long Road to Wealth. Let's look at a few more fictional yet relatable anecdotes. Javier's journey, from impatience to wisdom. Javier, a graphic designer, was drawn to day trading after watching a series of online videos. He imagined himself making quick profits and living a luxurious lifestyle. However, after several months of sleepless nights, high stress, and significant losses, Javier realized that day trading wasn't for him. He shifted his focus to long-term investing, reading extensively, and slowly building a diversified portfolio. Today, Javier enjoys steady growth and peace of mind, understanding that wealth creation is a marathon, not a sprint. Layla's learning curve. Layla, a marketing executive, invested in a popular mutual fund based on a friend's recommendation. Initially, she saw good returns, but when the fund's performance declined, she panicked and sold her shares at a loss. Determined to learn from her mistake, Layla enrolled in a financial planning course and started following investment blogs. She rebuilt her portfolio with a mix of index funds and bonds, focusing on her risk tolerance and financial goals. Layla's disciplined approach taught her the value of informed decision-making and long-term planning. Aiden's tech gamble. Aiden, an IT professional, decided to invest in tech startups. He spent countless hours researching potential companies, attending industry conferences, and networking with other investors. His first few investments were a mixed bag. Some failed, but a few succeeded spectacularly. Over time, Aiden developed a keen sense for identifying promising ventures. His story highlights the importance of due diligence, resilience, and a willingness to take calculated risks. The power of compound interest. One of the most powerful concepts in investing is compound interest. Albert Einstein reportedly called it the eighth wonder of the world. The idea is simple. You earn interest on your initial investment, and then you earn interest on your interest, and so on. Over time, this compounding effect can lead to significant growth. Consider Luna, who started investing $200 a month at the age of 25. By the time she was 55, with an average annual return of 7%, her investment had grown to nearly $240,000. The key to Luna's success was starting early and allowing her investments to compound over time. Practical takeaways for aspiring investors. Educate yourself. Knowledge is power in investing. Read books, attend seminars, follow reputable financial news, and consider taking courses. The more you know, the better equipped you'll be to make informed decisions. Start small. Don't put all your savings into a single investment. Start with an amount you can afford to lose and gradually increase your investment as you gain confidence and knowledge. Diversify. Spread your investments across different asset classes to reduce risk. A diversified portfolio can weather market volatility better than one heavily concentrated in a single area. Stay disciplined. Develop a long-term strategy and stick to it. Avoid making impulsive decisions based on market fluctuations or sensational news. Manage your emotions. Recognize that the market will have ups and downs. Don't let fear or greed drive your decisions. Stay calm and focused on your long-term goals. Seek professional advice. Consider consulting with a financial advisor who can help tailor an investment strategy to your personal financial goals and risk tolerance. A good advisor can provide valuable insights and help you stay on track. Quotes to inspire your investment journey. Let's sprinkle in some wisdom from renowned figures to keep you motivated. In investing, what is comfortable is rarely profitable. Robert Arnott. The stock market is filled with individuals who know the price of everything, but the value of nothing. Philip Fisher. Risk comes from not knowing what you're doing. Warren Buffett. An investment in knowledge pays the best interest. Benjamin Franklin. Inspiring real-life stories. The steady path of Margaret's investments. Margaret, a nurse, started investing in her late 20s. She didn't have a lot of money, but she consistently put a small amount into a retirement account each month. She chose a mix of index funds and blue-chip stocks, reinvesting dividends, and maintaining a disciplined savings habit. By her mid-50s, Margaret had accumulated a significant nest egg, thanks to the power of compounding and her unwavering commitment. Her story is a testament to the impact of consistent, long-term investing. Leon's tech venture. Leon, an engineer with a passion for innovation, decided to invest in tech startups. He spent countless hours researching potential companies, attending industry conferences, and networking with other investors. His first few investments were a mixed bag. Some failed, but a few succeeded spectacularly. Over time, Leon developed a keen sense for identifying promising ventures. His story highlights the importance of due diligence, resilience, and a willingness to take calculated risks. Conclusion: the balanced approach. So, can you get rich quick by investing? The short answer is, it's highly unlikely. While there are stories of individuals who have struck it rich quickly, they are the exception, not the rule. The vast majority of successful investors achieve their wealth through careful planning, education, and patience. Investing is not a get-rich-quick scheme. It's a journey that requires discipline, resilience, and a willingness to learn. By adopting the principles of great investors like Graham, Buffett, and Bogle, and by understanding and managing your emotions, you can build a path to financial stability and growth. In the end, the most reliable way to build wealth is through consistent, long-term investing. It might not be as glamorous as the tales of overnight millionaires, but it's far more achievable and sustainable. So take a deep breath, start small, and stay the course. Your future self will thank you. Answers to the quiz: do you prefer stability over uncertainty? If you answered yes, you might prefer a more conservative approach to investing, such as index funds or bonds. Are you comfortable with the idea of potentially losing money? If you answered no, you should be cautious and educate yourself thoroughly before diving into more volatile investments like stocks or cryptocurrencies. Do you have the patience to wait for long-term results? If you answered yes, you're well suited for long-term investing strategies. Are you willing to educate yourself continuously about the market? If you answered yes, you'll likely become a more informed and successful investor. Can you manage your emotions during market fluctuations? If you answered yes, you have the temperament needed to stick with your investments during both good times and bad. The business world moves fast, and the key to success is staying ahead of the game. The more you learn, the more opportunities you'll unlock. So, if you enjoyed today's video, hit that like button to support the channel, and be sure to subscribe and turn on notifications. We have plenty more business insights coming your way. And don't forget, join our community absolutely for free to get more information on this topic. Let's keep building, innovating, and achieving success together. Don't miss out. We've got even more free insights waiting for you. Click the link in the description and unlock the next step on your journey.